Good morning, Facebook. I'm Jill Malandrino, Global Markets Reporter for the Nasdaq, and welcome to Trade Talks, where we talk about everything option strategy, markets, everything related to trading. Joining me today is Rahbari of Stutland Volatility Group, and we are going to look at a way retail investors can use data available from the Nasdaq to set up their trading screens. Thank you, Luke, for joining us at the Nasdaq market site. So let's have some tips for retail investors how they can set up using data from the Nasdaq website for their trading screens.
Well, it's a great tool, the Nasdaq market site. So I would go there, get a username, and just kind of look around. There's a lot of stuff besides research and research on single stocks to overall markets. But you can go on there and set up your screens. I think the most important thing that some of the retail investors forget is that it's not about a single stock you own or a hot stock. It's about the overall portfolio and the risk to the overall portfolio and how you're going to hedge that risk. So the thing that I do is I take all my stocks and my trading screens, and I have 8 screens, but you don't need that many. You can open up windows or close them. But the first thing you should do is have the top indices right on top, right? You should have the Nasdaq, the S&P, you should be looking at the VIX, the dollar, and oil, right? I have those right on top, and that kind of tells me where the entire market is going to be. If the S&P is going up versus the Nasdaq, what's going on with it? Why aren't they both going up at the same time? Is the dollar really strong? Is there something happening overseas with oil, right? I want to look at those top things right there. After that, I'll have my most popular stocks and my biggest positions down below and see how those stocks are reacting to the market. From there, I also want to know what ETFs, what holders, what big indices are my stocks in. Is there something happening in some ETF? Let's say it has 10 names, okay? And 2 of my favorite stocks are in that ETF. Those 2 stocks are up, but that ETF is down. Why? What's going on in the market? Is it because the rest of the stocks in those ETFs are down? Is something else happening in the market? Was there some news about my stocks that has those single stocks going up, but the ETF not higher? So you always want to be cognizant of what's making your stocks move. And sometimes it's not about the actual stock or the single stock. It's about the indices. It's about what's happening in the overall market.
Well, let's go and talk about volatility, because overall vol has been really low, but there are some instances where single stock volatility has been elevated. Let's talk about that.
Exactly. So we've been getting a lot of calls and questions about that because people are seeing a lot of volatility in their single stock names or in some industries, but the overall market volatility, and a lot of people look at the VIX, obviously has been pretty muted. So I'll try to make this example as simple as possible. The VIX is a calculation. Market volatility is a calculation. It depends on how many stocks you're measuring and how volatile those stocks are. But lately, for the last 5-6 years, the market has just kind of been going up and all stocks have been drifting. That's not happening anymore. There's starting to be some break between single stock names. So let's take the Nasdaq, for example. 2 big stocks in the Nasdaq, let's say maybe Disney or Tesla, okay? They both have earnings in the same week. Disney comes out and it blows out earnings. Disney goes up 5%. Tesla comes out, it has bad earnings, it goes down 4%. Now, if their market caps were basically the same, that wouldn't have a lot of effect on the overall index, right? One big market cap is up 5, another one's down 4. Hasn't really moved that much. But if you own those positions, those are really big moves. And you're wondering what's going on. Hey, my stock is really volatile, but this index is not that volatile at all, right? So single stock vol is going up depending on what industry you're in, and you've got to be careful. Don't get fooled by the fact that index volatility has not moved up that much. Right. But it could, and it also represents an opportunity to use options, a lot of the strategies that you talk about, to hedge some of your single stock names with index puts or index volatility.
Right. Well, that's why it's so important also too to set up your trading screens, as you suggested, not just the stocks that you own, but the overall indices and ETFs that reflect those sectors, so you can pick out those disparities.
Absolutely.
Well, let's talk about something investors have asked us a lot. How do you calculate the expected range of a stock price going into a vol event like earnings?
Yeah, it's actually very simple. And I don't know, someone told me about this when I was starting out over 20 years ago, and I've never forgotten it. So here's a really easy method if you just want to calculate it. Whatever stock you have, the front month option is the option that's the first one on your screen when you punch it up. It's most likely a weekly option. It's got the least amount of time to expiration. So take that weekly option in relation to when the earnings dates are. So if your stock, to make it simple, is having earnings in that week, you take the front month option, and let's say the stock's trading at 46, okay? There's most likely a 45 strike or something, but even if there is a 46 strike, you want to get to the closest option strikes to the price of the stock, right? So for this example, we use 45, all right? There's going to be prices on the calls, and there's going to be prices on the puts. The 45 call, let's say it's at $5. The market is saying that right now the stock is around 45. We think the upside on this earnings move is going to be around $5. The 45 put might be at, let's say, just to make it easy, it's a big move, but $5 as well.
Right.
So they're thinking if earnings don't come out well, we probably think that the stock could go down $5. All right. So what you do is you add the premium for the call, you add the premium for the put. The call is the upside, the put is the downside. That's a premium of 10. You divide 10 into 45, right? You can do it by 46, whatever you want, adjust it a little bit. But that basically gives you what the market is expecting, the percentage move in the stock the market is expecting after earnings, okay? And then, again, you go back to the Nasdaq market site, or you listen to your show, which you have this on some of the popular stocks. You say which earnings are coming out, and you say, wait a minute, in my particular stock, the last moves have been 2 or 3%. Why is there such a big expected move this time? Find out why. There might be a reason. People in the marketplace are not dummies, okay? You just don't know yet, or we don't know yet. You have to find out why. Is it because other stocks in the same industry have had big misses or big earnings, and people are expecting this stock to also go up that high? So that's why you look at the ETFs that your stock is in, you look at those indices that your stock is in, and you look at how earnings have been acting in those stocks, and then you say to yourself, you know, I don't really care. Maybe I don't think that the stock is going to have such a big move, and I'm willing to sell that straddle. Or I'm okay with it if it goes down. I'm willing to sell that put. 42 has been my entry, $5 for a 45 put. I'll do that all day long because I don't mind buying it down there.
Right. Well, it's also another way to average into a stock in a better way. And, you know, selling puts, you have your advantages. You can get the premium off of that as an income strategy.
Sure.
But if you like the stock at 45, you like it at 42, so you could get more attractive entry point if you miss that move. And that's a question that a lot of investors are asking. I talk to traders all the time, and they're like, Jill, we would welcome a 3 to 5% pullback so we can reposition. So let's wrap it up, and let me ask you this. Based on what you're seeing with options activity, what are your thoughts on market sentiment? Do you think we might get that pullback for traders to get involved?
Well, it depends on which stocks and what industries, but I will say this, the PE ratios are getting a little rich for me on the overall market. And also, whether you agree or not agree with what's going on politically or globally, that doesn't matter to the markets. You have to deal with it. So I think what's going to happen with this administration is they're going to do a lot of different things. Some of them are going to be good for some industries, some not so good. Give you a quick example, the infrastructure bill. If that goes through, that's going to be good for a lot of different industries, right? The pharmaceutical industry, they're not so hot on. They're not so hot on the so-called price gouging and what else is going on, right? So those are the things you kind of look at. It depends on the industry, but overall, for the overall market, I think it's starting to get a little rich. And if volatility is so damped in these indices, start to look at ways to hedge your single stock positions with some index volatility or index options. And if the market goes up, you own the single stock, and you paid a little less premium for the protection on the indices because the vol is muted.
All right. Well, thank you very much, Luke. We look forward to having you back with me in April.
Thanks for having me.
And thank you, Facebook. I'm Jill Malandrino, Global Markets Reporter for the Nasdaq, and this is Trade Talks.